Hello, and thank you for joining us for today's deal launch webinar. With us, we have Chad Pope and Andrew Mobsby of Cashbox. Today, we are going to be discussing the newest structured note from Cashbox, the BBVA car manufacturer's 50/50 structured note. I'll kick it over to Andrew and Chad now, just to get us started and teach us a bit more about this note in particular. Thanks so much for joining us, Chad, Andrew.
Gabby, thanks so much for inviting us. Always great to be in the community. Great product to offer today. So yeah, thanks for the opportunity. Can I share screen?
Yes, you should be able to.
Second. There we go. So Gabby, thanks again. I'm delighted because Andrew and the structuring team have put together a really interesting opportunity here. It is a quick open and close. So this will be closing on Friday the 30th at the latest. There's a time to fill, and once this is filled, the product would close. And I'd love to run through the details on how these work again, just as a refresher. And then Andrew will take us through the product that he's designed to fulfill these particular coupons and this flow. So as you'll remember, folks, the banking sector is made up of central banks, falling down into investment banks, running down into business banking, and then high street banking. High street banking and business banking, traditionally for transactional banking, and as you'll know, offer very low returns for cash deposits. If anything, just a couple of %. What Cashbox has been able to do, and through Andrew's relationships and time, is take everybody from high street banking all the way to investment banking. And investment banking is where institutions would go and bank, where they would create products and investments. Trusts would operate at that level, banks themselves, high street banks, pension funds, etc. And this is where wholesale or institutional levels of return are produced. So for our deposited structured notes, you're looking at 12–14% per annum, and these will be paid out on a quarterly basis. And we'll take you through how this all works. But at this level, we can package, we can get these products underwritten, they'll be issued off the bank's balance sheets, and typically, again, for high net worth and institutional type investors. And the great news is we can get everybody in for a much lower number. In fact, I think there may be a special being offered by Wealth Migrate. Gabby, you can tell us the entry level in a minute. So what we've done, folks, is we've really bridged the gap between retail and institutional, taking us from high street banking to investment grade banking. And this bridging the gap is a theme that you'll see in all of our products. And these are designed then for these predictable levels of return and very deep levels of capital protection, which I'll take us through again. And of course, only through A-rated investment grade banks. How do we get into these and how do we operate? We operate in a highly regulated environment. So you, the investor, would fund your platform and your wallet, being Wealth Migrate, and all the funds would flow and the contract would be created between the investment bank and your platform. And what this does is it keeps our funds in a regulated environment, in probably some of the toughest jurisdictions in the world in terms of regulation, which is exactly what we want. As you'll remember, Cashbox and IDAD put our heads together, we create the products, we then take the product to the investment bank. The investment bank says, yep, this is a great product. We're happy to underwrite it and we will launch it. And then the funds would flow, the coupons and returns from your investment bank to your investment platform. And of course, what's nice with those quarterly coupons, I could elect what to do with that. Perhaps I want to balance my portfolio. Maybe I want to buy more structured notes. Maybe I want to buy property, whatever it might be. I have that opportunity to recycle and reinvest, which makes this a really interesting offer. So I'll take us through an example on how structured notes are structured, just as a reminder again, and the levels of protection that are built in. we would have our start value. That would be the start value of the shares. Andrew's going to take us through the three that are in here and why the automotive industry presents really great value at this point in time and why they were selected. But let's say we start again at 100% of their start price, their strike level. We're going to monitor those and measure those every quarter. We're going to build into the product very deep levels of income protection and capital protection. So in this particular product, although our example says an income barrier at around 60%, as you can see, I don't know if you can see my mouse on the screen. What that would mean, again, folks, is even if the shares were to drop in value all the way, in this case, to 60% of its start price, so they would have degraded by 40%, every coupon, every quarter, my income is going to flow. So as long as my stocks remain above 60% in this case of initial start, my funds will flow every quarter. We build in here a really cool feature called an income and auto call trigger. The auto call trigger in this example is set at 95%. And what does this mean? It means that the bank has the opportunity to call the product a bit early. In other words, the product would mature early. We like this because we get the opportunity to take our capital back out of the product, having collected all our coupons, and then go and reinvest it again. Let me take you through a couple of more examples. And this is a fictitious market cycle, just so we can chat around the different eventualities that may or could arise as the product runs. So again, we've got the set of products, or basket of products as they'd like to refer to it, and they start to rise. Let's say in the first quarter, I'm well above the income trigger level. It's going to pay the 3% coupon in this example. Let's say the markets turn and they do start to drop, and perhaps at quarter two, we've lost 20% of value in those shares. We're well above 60%. It's going to pay out the quarter and the extra coupon pays out. Now we build in another level of protection called a memory feature. And in the eventuality, unlikely, but possible, I guess, that the stocks drop more than 40% or by more than 40%, as you can see, and we breach the income trigger level, I get the coupon to hold. It won't pay out, the coupon will hold. And what I do is I sit tight, I wait for the stocks to start to rise again. Perhaps by quarter four, once we're above the income trigger level, yes, that coupon's going to pay out, but the memory feature kicks in. And this is really nice because it's going to pay back any lost or missed coupons. So what I've done now, instead of taking this market ride, this roller coaster ride, I've gotten flat, steady, predictable income every quarter. I've built up a steady flow. This is a scenario that we're designing for really, and that's at some point in time, these stocks are going to rise above the order call trigger. The product is going to close or mature early. It'll pay me my last coupon and it'll pay me all my capital. I take that again and go and reinvest. That's exactly what we're designing for. And the way we like it and the reason we like this is when this product calls and my capital comes back, I can reassess the market, decide what to go and invest in next. Could be another structured note, could be a value opposition proposition that you have elsewhere. Gives us the ability to do what's correct in the market at that point in time. If, however, the product runs and it doesn't get above the order call trigger and it runs for the life of the product, let's say to quarter 20, in this case, it runs its full 5 years, the product would then pay out the coupons every quarter, and at the end of the period, our capital will be returned. This piece here hasn't happened in the last 5 years, but we have to discuss this. So what happens if one of those if one of those options drops below our capital protection barrier, below 50%? So it's halved in value and a bit more. Let's say at a 47% of its original start price. This is the time my capital is at risk only. And then it is possible, if the lowest one closed at 47%, I'd get 47% of my capital out. Of the 936 products that we've been involved with our structurer in the last 5 years, this situation has not happened. Is it possible? Yes, it's possible. Is it unlikely? It's highly unlikely because it's not in the design of the product. But we need to mention, of course. So I'm going to hand over to Andrew to chat through the new product. And as we said, it's closing next Friday. That's the 30th of April. A really, really interesting product. Well done, Andrew. This is looking cool.
Thank you. Hi, everybody. Chad and I are sitting very close together because we, for once, based together in Eastern Cape on a roadshow. So we're sharing a table and the laptop. Yeah, I think if I can give it context, 2020 was a very tough year. The recovery that the markets, especially the United States, experienced was driven out of the tech space, the digital space. The futuristic world suddenly became our reality. Words like Zoom, Amazon, eBay, online portals, artificial intelligence, all those things that we thought were in the future, we now live with and pretty much are regarding as a part of our day-to-day existence. And I think one must put in context that tailwind that we followed very successfully during the launch of our notes in 2020, and was a feature of our notes in 2020, has carried on into 2021. But what we have started looking at is that everything, all trends have a lifetime and have a span. And we've started looking at if I can call them the bridesmaids of the sectors that didn't participate in that expansion and that recovery last year. So yes, while big tech did very, very well, there were a lot of quality companies in great sectors that just didn't, they were the bridesmaids, if I can call them that, of the recovery. And we, in fact, in January of this year, February, Wealth Migrate's first structured note was based on this rotation into value, if I can call it that, where we rotated a little bit away from high tech, and we went into a sector that was showing extreme value, and that was in the banking sector. Banking stocks were absolutely hammered during 2020 from a number of reasons. And this particular opportunity is, again, based on this rotation into value. The interesting connection, though, there is a connection between the tailwind of all that tech and the automotive or automobile opportunity that we're now presenting. There is a definite link. So we're not going to be talking about, are the companies who are involved in this producing more cars than the next company? It's really a fork in the road for this particular sector. The fork in the road being that 2020 changed everything for us. It was changing in any event, but certainly the way forward is going to be premised on the directors and management team, their futuristic view and current view of taking the right fork. And the right fork really is the evolution of the automobile industry. We've all heard about green energy. We've all heard about sustainable energy, battery power, electric cars. And specifically in that space, the electric vehicle market is going to be I've called it often, so over and over again, and so often, it's going to be a battlefield, because we've had one or two companies that have absolutely dominated, but it's a sector that's not going to be dominated forever by one particular company. So all the big motor manufacturers are now coming to the party in terms of this green energy, sustainable energy, electric vehicles, etc. And it's not really just about electric vehicles. It's about how that cultural shift will change society and the way we treat our cars. I've always grown up in a petrol head environment, and people have always said your car is an extension of your ego. And I think that will certainly be the case in the future, but certainly I think we've seen it already. This started happening before the pandemic. Ride hailing, your Ubers, driverless cars, AI, robotics, that's all part and parcel of what makes up this particular note. So it's not just automotive cars, because cars in the future and the ownership of cars, the value of a car, the use of a car is going to become very, very different as these major structural shifts occurs in the transportation industry. Chad, are you driving the particular slide? So let's have a quick look at this. The issue is BBVA. It was the same investment bank that issued the last structured note for Wealth Migrate, a large international, global, but mainly European, Spanish investment bank, rated about the 14th, 15th largest in the world. The coupon, it's Wealth Migrate will be offering this in US dollars at 3.5% per quarter. That's 14% per annum. Chad has gone through some of the terminology on the left-hand side, the income triggers. The term is 4 years. That's maximum. but this could mature as early as 6 months. So the first opportunity to auto call, as you mentioned, could happen from 6 months and then quarterly thereafter. So you'll be picking up a coupon of 3.5% every quarter until such point, subject to terms and conditions. And then finally, if it goes above 90% of start price, well, then it will end. So it's a good opportunity to roll up some really, really attractive payoffs and some coupons. There you've got your auto call trigger. The bank's offering a discount. So it shows the veracity and the appetite for the bank to actually get hold of these actual options to convert them into shares down the road. So that sort of implies that they'd like it to happen sooner or later. So I do say to some clients, there's a risk in that because this may only last 6 months. The flip side of that is that you've got an opportunity with your advisor, with your team, your counsel to say, do we rebalance? What do we do with this capital that's been returned plus all the coupons? Do we fill and go again? It's a good opportunity to have a look at the environment that you find yourselves in. The reference basket I'll deal with briefly. This is automotive, so those names are household kind of big names. Volkswagen and General Motors are generally regarded as heavyweight blue chip shares, defensive type of stocks if you had to buy them in your own right for your portfolio, but very blue chip. General Motors, 7th largest manufacturer of vehicles in the world, and most people associate GM with gas guzzling big American cars. But I'll tell you a little bit about it. They've got a female CEO who's very much in tune with the whole Biden administration. They're going to be a beneficiary of the huge fiscal spend that administration wants to spend in sustainable energy. But yeah, 7th largest, and it's certainly 112, 113 years old. So it's one of those fabled, very, very old companies, been around a long time. Volkswagen, what can one say about Volkswagen? It's a world prestige brand. It owns a plethora of different companies, mainly in the high mark area. So I'll give you a quick rundown. Some of the companies that it owns: Lamborghini, Bentley, Bugatti, Ducati, the superbike owners, Audi, Seat. So there's a range of high quality vehicles and high quality opportunities and market spread. Volkswagen recently threw down the gauntlet to the company at the bottom, Tesla, who are probably the kings of electric at the moment. And they said, we will take you on in terms of becoming #1 in the world. And certainly with their distribution force, their manufacturing capability and marketing, this is a very, very exciting space to be in. But it's not just about cars. It's about how the cultural behaviors are going to spin out of that. So generally speaking, we've seen since the recovery last year, we have seen recovery in GM. We're starting to see recovery in Volkswagen quite nicely. Tesla's actually, for a sense of this particular product, its values are actually coming down, so it's making it cheaper, slightly cheaper. It went to stratospheric heights because everybody just pitched into it, and momentum investing took it to sort of eye-watering levels. But it's about the industry. It's about the associated industry those companies are involved in. So all three have certainly that fork in the road I talk about. They've all basically espoused the view that you have to take the right fork, and that is into the more sustainable space. This type of transportation is going to take over. Just as a quick anecdotal story, the UK, for example, is going to ban the sale of new combustion engined cars by the year 2030. Okay, so in other words, you won't be able to buy a petrol or a diesel, brand new petrol or diesel vehicle. That's the British government. You'll be able to buy a hybrid version of that up until 2035, and thereafter it will be electrified. So if you think about the consequences of that, the infrastructure that has to be built across, UK is quite a small place, but imagine putting the infrastructure into the United States. That's a huge, across time zones, it's a huge country to have electric points to charge your vehicle as you go from east to west or vice versa or north to south. So there's a lot of spend in this whole space around this, and certainly the fiscal input from, for example, the American government, the US government, absolutely massive. So the GM and Tesla, certainly in that space, are going to be massive beneficiaries. China is moving very, the world's second largest economy, biggest consumer of cars, if I can call it that, 25 million. It's both those companies, certainly Volkswagen and Tesla, have major manufacturing operations in China. So the world of emissions, green space is all coming through. It's a very exciting space. It's the rotation into value. It's diversifying your portfolio. So clients who filled up on tech last year should be looking at a diversified basket. And this is certainly a great opportunity to look at household name companies in a reference basket. This is a great slide. I love this slide because it gives you that, as Chad was talking about, predictability and certainty. This is your timesheet. This is your timeline in terms of the observations, the quarters that are going to be observed. It fixes the date. This is contractually underpinned by the issuing bank, by the investment bank. These don't change. Nothing on this contract will change. So your dates are locked in. Your payment dates, generally a week later, are locked in. And it gives you your auto call triggers, what have to be achieved, and certainly your coupon triggers. So it's there in black and white. It's great. You can work out your cash flows, your CapExes. You can work out flows in terms of how it can augment your other fixed income and cash reserves. So this is a great snapshot in terms of what we set out to actually do, predictable income flows. Let me take you through some of the risks, proofs, and fees. I think risks, issuing bank, absolutely crucial. This is the bank that underwrites the capital. It has to be in a robust, regulated jurisdiction, an A-rated bank with the credit rating agencies that can absolutely support this type of product on its balance sheet. Bearing in mind, they guarantee the capital right the way through the product. It's only at that very final observation, as Chad pointed out in the previous slides, that is only at that very last observation, if it hasn't called earlier, that it could be at risk. The underlying stocks, a lot of work goes into this from the investment bank specifically. We have the ideas and approach them, but they look to see what appetite they have for it. So they put a lot of work into this in terms of the examination of what companies work best together to get the desired payoff. The banks are creating this product in their favor, so we are tying into that potential payoff that they're creating for themselves. It's predefined, so we give up, if those companies do shoot the lights out, we are defining our return at, in this case, 14% per annum. So if those stocks did shoot the lights out and do 30%, we give up the difference. That difference goes into buying our security. It buys you the peace of mind. It buys you very, very deep levels of protection that you will not get in the retail space. I can guarantee you that. You'll see products, but they will give you a much weaker capital protection and a much harder income trigger. So we call these 50-50s. It's a nice adage. It works very well. It's a simple protection. These major worldwide companies have to more than halve before your income flow is at risk. That's quite something. We didn't see any of that during the pandemic, or the worst case in March 2020. Early exit, we must talk about. If something completely untoward happened and you needed to exit, it's based on a willing buyer, willing seller. And clearly there, if the market is at 6s and 7s and has taken a major dip, there could be a risk to capital and the preservation of capital. But generally, we say to a client, if it has a maximum 4-year term, sure, whilst there are opportunities for early maturity, regarded that you will run it to maturity on that basis. The proof, we work very closely with one of our counterparties, IDAD. It stands for Investment Design and Distribution, a UK approved, FCA approved company. They have produced, certainly since the last 5 years, since 2016, something like 936 structured products. And every one of them, if I can use the Cashbox adage, everyone that had writing on the outside, what it said on the outside of the box was on the inside of the box. They delivered exactly to term and to the terms and conditions of their contract. So thoroughly well researched. There also is extensive back testing on every single product before it goes into the market. For our perspective, last year, it was a very, very tough year for everybody. But from a structuring perspective, when the banks had the appetite, it was the most wonderful opportunity to get in at prices we hadn't seen in 10 years to strike those deals. And many of those products that we launched during 2020 are actually maturing. We already had one matured in February this year, and we're having one on Friday. So fantastic opportunity to access the markets at ridiculously low valuations. And certainly from an overall return, 14% in sterling, and in US dollars, around about 12%. The fees, obviously something very important to those quoted numbers, 14 and 12 per those currencies, are net of fees. In other words, a £10,000 or $10,000, by way of illustration, example, is fully exposed. You have total subscription. There's no deductions on a upfront, initial, ongoing, or otherwise. It's baked into the ultimate price. So when you see a product, a Cashbox structured note, the prices and the fees are already built into that actual payoff terms. Cashbox does receive, obviously, we'd love to be a charity in many respects. We are. We do a lot in terms of our community, in terms of education, and certainly co-investing and giving back. But we do receive for placement of deals through the investment bank, so it doesn't affect your subscription. It doesn't come out of your capital. It's paid away by the investment bank. And that's something that we feel very strongly about in terms of keeping the fee structure as lean and mean, and obviously keeping the ultimate returns to the investors as buoyant as possible, because this is where certainly the ultra high net worth space that's where ultra high net worth investors in that space expect. So we are bringing that type of scenario to a much lower level in terms of, instead of bringing $1 million to the table, we can bring 10,000, for example. The trading platform that you work through, that's, we obviously, our products have to be accessed through a regulated and approved platform. And certainly, there are fees involved with that because they're offering you a value service in terms of onboarding, holding as custody, transacting for you, making sure that they can report to you, and keeping the investment up to date from an administrative point of view, safe and sound and tucked up tightly. So that needs to be just considered. So yeah, in conclusion, thank you very much. We're very excited, very proud to bring this to market. The one caveat is that for the first time in a long time, the fund managers around the world are starting to look at this and they're starting to gobble up inventory. So we're hoping that we can keep the offer open as long as possible for you. Chad.
Cool. Gabby, thanks very much for the opportunity. Wanted to see if there are any direct questions. Otherwise, we gladly answer those as they come up.
Amazing. Thank you so much, Chad and Andrew, for your time and for walking us through this deal. So appreciated, and certainly sounds like quite an exciting opportunity to very quickly invest in, given the short window to raise. For our community, so that everyone is aware, I'll just quickly share my screen so we can. Nope. Let me quickly share my screen again. Here we go. If you log on to our marketplace, you will be able to see under review upcoming deals, the BBVA car manufacturers 50/50 memory auto call note. As Andrew and Chad mentioned, there are fees associated for our investors, though very minimal. We will charge a 0.5% initiation fee. So if you are investing 10,000 into this note, you can expect to be charged just a $50 upfront fee. That allows us to cover the cost of structuring this note and paying it forward to Cashbox. And then there is a 10% success fee associated with your any capital returns earned over the course of the note. So you can see quite clearly here on the actual deal card in our marketplace what your projected returns might be depending upon the investment amount invested. So for our members, that will be a reduced or adjusted cash on cash return of 12.54% or 3.32% per quarter, and an average total net IRR of 12.44%. We will also be hosting a Q&A session with Chad and Andrew next Tuesday on Freedom Day, later in the afternoon, and we will be sharing all of the details to register for that webinar with our community. So any questions that you have about this note, certainly prepare to be involved in that session. We're very excited to be able to offer it to you. Other than that, thank you so much for your time. Chad, Andrew, it's a pleasure as always.
Thanks, Gabby.
Thanks, Gabby.